Hi, everyone, and welcome to another Risk Awareness Week workshop. Today, I'm joined by Shayne Kavanagh, who is the Senior Manager of Research at GFOA, and Shayne will talk a little bit about what they do. As always, remember to keep this interactive, ask questions, write comments below this video, and the links to the slides and some of the materials that we're going to talk about today, you will find in the middle of the screen to the right. So Shayne, thank you. Welcome to the Risk Awareness Week. Thank you for the second year, and tell us a little bit about what you guys are doing at the association and what we're going to talk about today.
Sure. Well, thank you, Alex, for having me here. It's my pleasure to join you and your group to talk about this. So first, a little background about the Government Finance Officers Association, or GFOA. We are a nonprofit membership association of about 22,000, a little more than 22,000 local governments across the US and Canada. So if you are watching this from the US or Canada, the CFO of the city you are in is probably a member of GFOA, or at least one of our state chapters. And our role is to promote better local government and better financial management of those local governments in the service of thriving communities. And what we're going to talk about today in particular is cyber insurance and cyber risk savvy, because just like many other types of organizations, local governments are dealing with cyber threats. And in fact, local governments are the most popular target for ransomware in particular. So our sector has a special interest in this topic.
And can I just add, by complete coincidence, I actually happen to work quite a lot with local governments in Australia, and city of Sydney, Melbourne, and some of the smaller towns in New South Wales. And I was always amazed at looking at different comparisons, because in US, Canada, Australia, I saw local governments, and these are the organizations that impact our day-to-day life. Like the decisions that they make, it has almost an immediate impact on the population living there. And I was amazed by the contrast on how local governments in these countries, kind of these English-speaking countries, were really moving towards this kind of financial literacy and maturity in risk management. And I saw a lot of local governments in CIS and Europe that didn't even know the word risk management. So it's so pleasant for me to see the amazing work you guys are doing. You're trying to kind of educate and raise risk awareness to your membership base, because essentially this is what Risk Awareness Week is all about. It's taking different concepts and different risk disciplines and simplifying them, and then communicating to the widest possible audience to make sure that we all benefit from this kind of competency of risk analysis whenever we make decisions. And buying insurance is quite an expensive and a very quantitative prone risk decision.
Yeah, well, I'd agree. In fact, we'll get into this a bit more detail, but just to your point, right, we've done research in employee healthcare insurance before, and different strategies for containing costs, and research there shows that local governments tend to underutilize self-insurance strategies compared to the market in general. So to your point, there is, I think, opportunities for savvier insurance strategies.
Because for local governments, overpaying for insurance means less budget for other important, city initiatives that benefit the community.
Exactly. Cool. So should we jump in then?
Yes, please.
Awesome. All right. Well, good. So there's a 4-step process for cyber insurance that we outline in the research report that this is based on. And I probably should mention the last slide was the cover of that research report. And Alex, I imagine we can certainly put the link to it for interested folks in the chat or otherwise in the notes.
Absolutely.
For this presentation.
It will be available for download.
Awesome. And what we're going to focus on here today are these 2 steps within this 4-step process, which credit goes to Anne. This is based on their cyber loop approach to considering cyber insurance. And what I'm going to do here is jump into the kind of first point, which is, if we're going to talk about quantifying risk, we probably have to address the common alternatives to quantification, and perhaps the most common and well-known alternative to quantification is the good old risk matrix. And I'd imagine that, Alex, your audience is pretty familiar with this. I'm sure people have seen some version of this sort of thing where you've got this color-coded heat map of likelihood versus impact for a risk of some that you're evaluating. And the kind of punchline here is that research shows that risk matrices are often not only ineffective, but can lead to worse decisions. And so one might ask, well, that is surprising. Like, why would that be the case? And the one of those reasons here is the illusion of communication. And what I've shown up on the screen here is the different, we'll call them like qualitative ways to describe uncertainty, right? From almost certain all the way at the top to chances are slight all the way at the bottom. And then on the horizontal axis, you've got assigned probability. So in other words, if this study that produced this chart said, let's pick we doubt. So if you can see my kind of we doubt line there in the middle, the people who said, well, we doubt this is the case, they were then asked to assign a number to that. When you say we doubt, how likely do you mean that is? And then you can see about people there, 30 to 40 is common, but you see like there's like some people who are like, well, 70, some that are 10. You can see over the little lump all the way over to the right. There are some that are even approaching like the 90 mark, which is a bit weird. But the point being is that there's a fairly big range of what people meant when they said we doubt, when you translate that into a quantified probability, right? And you can imagine this is going to create some communication problems. If I say, well, I doubt this is the case, and I mean 10% likelihood, and someone else says, well, we doubt, and they mean like 50% likelihood, that's a pretty big gap. And you've got this sort of problem up and down the whole range of qualitative probability terminology. Next point here is analysis placebo. And what this is really getting at is the risk matrix gives you kind of this illusion or like kind of feeling good that you've done the thing, you've analyzed the risk, but you've not actually quantitatively understood the likelihood or the magnitude of that you're facing with this risk. So you're not going to make the best decisions. So that kind of in a summary is why risk matrices are leading to worse decisions. And the question here is, well, what is the alternative? And I would propose it's quantification of risk. And if we define risk as loss times magnitude, to me, that implies an ability to quantify this. And kind of what we say as part of our message, I'm not suggesting here that your audience members here all need to go out and become actuaries, but you can at least start thinking about this in a more quantitative way and ask for quantified risk from your insurance providers and other folks that are part of the risk management program. So
in here, I have this very important message that I want everybody watching us and listening to remember. We don't want us to become an actuary, but we do want to have a look how actuaries actually think about your risks and how they price your risks. And because we've done that, what we have discovered for many insurance types, the models that actuaries actually using are quite basic and in fact are quite easily replicable by us, by just normal public. So what we're trying to say is that we kind of, for some insurance lines, we know the trade secret that the industry is using, and we can try and replicate that trade secret with very little effort required and very simple math to have the same view of the risk of the insurance product as does the kind of this secret black box that sits somewhere in the basement of an insurance company. For some reason, I always think of the basement of Pentagon where the quant risk analysts are sitting. So I presume in large insurance companies, they also put all the actuaries in the base. That's, by the way, that is obviously not true. I'm just making a joke. Actuaries actually ridiculously well paid. So what we're trying to do is we're trying to peek behind the curtain, see what the market does, and if we can replicate it, we would be on par, kind of equal in negotiations, because at the moment, they're talking from a position of power, and we're talking from a position where the insurance buyers, we're talking from a position of weakness where they tell us how much it costs and we have nothing to challenge. So we can actually, bridge that gap between the seller and the buyer and see if we can kind of level the playing field. So this is what our talk will be about today.
Yeah, absolutely. Thank you, Alex. And with that, this is probably a good segue to, hey, let's see some actual data. So we've talked about data and the need for quantification. Let's actually get into that. So the first one here, I'm going to focus on ransomware because ransomware, I think for many types of industries and especially local government, is the most prominent and clear and present danger when it comes to cyber risk. And the kind of point of this slide here, and this is courtesy of Net Diligence, by the way, is that ransomware damages follow a skewed distribution. So just to give you some numbers on this, so the median cost of to a small or medium enterprise and is $98,000 in 2001, and the average is $267,000, and those two figures are quite different. And what that really means here is this is a version of what I might call the Jeff Bezos problem. I might have heard this as the Bill Gates problem, but either way, it goes like this. Imagine you are in a room of 10 people where one of those people is Bill Gates. In that case, on average, everyone in that room is a millionaire. And that's because you take everyone's wealth, add it up, divide by 10, you get a number north of $1 million. But of course, that is not a good description of the average wealth or the median wealth in that room. And the same problem here is that what's going on is an extreme value within your set is pulling up that number. Pulling up the average, and that's exactly what goes on in the world of ransomware. This is very similar to like earthquake risk or hurricane risk or other kind of natural catastrophes where the big one, so to speak, is catastrophic and pulls up the average damage far over the median damage. We can actually put this in a little picture. So this is what we're not dealing with. This is a normal bell-shaped or symmetrical distribution where mean, median, mode, they're all the same. They're all right in the middle. This is what a asymmetric distribution looks like, where the median and the mean are quite different. And what this means, you've got the tail of this distribution can be pretty large. And in this case, according to the data that we had access to, 10% of ransomware costs for small, medium enterprises, I should say, costs more than $638,000. So it's quite a bit of money and quite a bit more than when you're talking about like the median or even the mean. So kind of understanding that you're looking at risk as a distribution is a pretty important point. And as I mentioned earlier, different shape than maybe some other risks that folks deal with. So in my world, like cities have to plow snow, and snow tends to be normally distributed, and employee healthcare would be another thing, and governments have staff that they provide with healthcare, and the costs for a healthcare plan are also tend to be normally distributed. So it's important to know that you're dealing with a pretty different shape.
Different shape of a risk. I like that very much. By the way, we actually did renew our health insurance for we have approximately I think 200,000 employees, and we modeled and backtested and did confirm that the health insurance is normally distributed or very close to, which is a very different beast to cyber, cargo, or property damage or business interruption, to most other insurance types. And by the way, if you're watching this, write in the comments, what do you think would fit the distribution on the right? What are your suggestions? Because most of the people probably wouldn't recognize the name of the distribution by its shape, but some of the listeners I know, especially the people who have been watching Risk Awareness Week for the last 4 years, they can probably guess at least three different distributions I can think of that would fit cyber.
Yeah, it's very interesting. All right, cool. Let's see. So then the kind of next point I want to make here is that ransomware costs aren't stable. And so what this is showing is that the costs go up every single year in 2021. And again, courtesy of Net Diligence, I was talking with the folks at Net Diligence about this. They're like, all right, we have the 2022 data, but we can't release it because we're going to release it at our own conference pretty soon. And you didn't want me stealing my thunder, which is completely understandable. But their point is that the trend did not abate in 2022. So the cost of these ransomware attacks seems to be going upwards. So kind of understanding that you're not in a stable environment is very important, right? Because many insurance more traditional insurances like your properties or whatnot tend to kind of just go from year to year for many purchasers with little change, but we're not in that type of environment. And maybe a kind of side point to this is because of this lack of stability, right? It can be harder to actually get these policies. So in our world, in local government, we have found that many of our members have found that the premiums for their policies have doubled within the last year if they're able to get the policies at all. The underwriting requirements have gone up dramatically. In fact, I did a presentation with Ann at this at GFOA's big annual conference, and my Ann co-presenter had I go call it clever slide where he showed the 9 things that you needed to do to impress your underwriters, and that sounds like a lot. And then his very next slide was the 12 things you need to do to impress your underwriters, to kind of make the point that this is an evolving situation here, where it's like, maybe last month it was 9, this month it's 12. I don't know, maybe by this point it's 15 because that was in June. So the kind of point being, we're not in a stable market, so kind of understanding movement and the volatility is pretty important. And the kind of next point I should say I want to make here is that damages are only weakly related to organization size. And so this is small and medium enterprises again. And what this is showing is we've got a little scatter plot. And really the kind of big point here is that if you look at the, if you can see my cursor over here on the right-hand side, where we've got the R square is 0.09. That's really bad. So if you're not in statistics, let me just tell you that that's not good in terms of showing a relationship. So like a 1.0 would be a perfect relationship. So 0.09 is really low. And so what that's saying is that there's just not a whole lot of predictive value between the size of an organization and the size of the damages that it gets. So in other words, if you're a small, really small organization, thinking, we're small, what's the worst that could happen? Well, it turns out the worst could be pretty bad because there's not a whole lot of correlation between size and total damages. Now, I will say that for the much larger organizations that are not small and medium enterprises, there's a bit more of a relationship, so it's not quite that low. So Alex, if you've got people who are part of much larger organizations, this is not entirely true for them, but it's still not a highly predictive relationship. And then the kind of next point I want to make here is with loss exceedance curve. So what can you do with all this types of information? So if you have data about the potential size of an attack and the potential frequency of an attack, you can develop depictions of the risk. And I've chosen one particular depiction here. There are many ways you can go about it, but I've got loss exceedance curves shown. And just a little bit of background is we worked with one of the local government insurance pools in our network to get estimates from them about how frequently they see cyber attacks amongst their membership in the risk pool. It was about a 5 to 10% chance of a given member experiencing a successful attack. And so we use that data to develop this loss exceedance curve. And what this curve is showing us, I have zeroed in on one particular point here just to kind of illustrate where it shows us that there is about a 5% chance, or 1 in 20, of a successful attack costing more than 1 million, because you've got about 5% right there, 1 million's right there. Those intersect on your curve. So this kind of shows us that a couple things. Number one, there's a really long tail, which is consistent with that really long tail distribution that we saw earlier when we compared it to the normal or the bell-shaped distribution. And but it also shows that there's kind of a high number of attacks that could have cost not that much, right? Which is also very consistent with the picture we saw earlier. So kind of another way to visualize that. And then the next point I want to make here is you can also change these curves or adjust these curves to show the benefit of investing in new controls. So when I say controls, I mean cybersecurity investments, like maybe it is data backups, or maybe it is safe computing practices, training in that for your employees, whatever it may be. Things that could reduce either the probability of an attack occurring or the potential damages of an attack if the attack succeeds. Either of those can shift down the loss exceedance curve, and then you can compare the old loss exceedance curve to the new loss exceedance curve and consider if the investments in cyber controls are worth it based on the change in your loss exceedance curve. And then one last point, or actually the next point we're going to get into here is talking insurance. So kind of what some of the implications are here for your insurance purchasing strategies.
So thank you very much for the introduction, kind of in the background on the story. The risk is growing. I think that's the kind of the key takeaway. The risk is quite significant, especially for local governments. That's a significant amount of money to lose in the kind of worst case scenario. And I guess the other kind of unfortunate side of cyber is that the loss is not capped. Like it's not a cargo loss where the maximum you can lose is the ship worth of goods. The losses can actually be quite significant to the agency.
Yeah,
and
you get into business interruption and cascading losses and all sorts of things.
Absolutely, which complicates the math of calculating the tail side of the distribution. But what I think the key takeaway from your presentation so far is by understanding the frequency of events, and it's probably more frequency than probability, because a number you would expect more than a single event in a given year.
Yeah.
Understanding the frequency of the events and the kind of the range of the consequences of a particular cyber event, you can actually combine them together using a Monte-Carlo simulation into a loss exceedance curve that gives all sorts of valuable information. It tells you what the expected losses are. So that's that would be either something that you would budget for as an agency, basically like on average, what sort of losses do you expect in a given year related to cyber incidents? And that could become an input into the budgeting process, or it could become an indication from which you start calculating the fair price of insurance. But it also gives you the kind of the 95th or the 90th percentile of the worst, kind of your plausible worst case scenario. And depending on what the agency or the government or the company appetite for risk is, or confidence level, then that metric becomes very important for making all sorts of other decisions with insurance, which we'll talk about in a second. So what in your experience are some of the kind of biggest challenges when starting to have that conversation? Because in the middle you mentioned, I know it was a joke, but it was kind of, it was close to my heart. You said, yesterday it was 9 points to convince or to impress the underwriter. Mm-hmm. And then the next day it was 12. That struck my heart very much, because as an insurance buyer, I had a very different mental model in my mind, where underwriters needed to impress me for me to understand that I feel comfortable transferring my risk to them. Because in different insurance lines where we've actually done a lot of backtesting and calculations, what we discovered is that insurance as a product is not cost effective. It is designed in the way that you significantly overpay for transferring risk. And mathematically speaking, most of the time you're much better off retaining the risk and basically just reserving it. And the only kind of real value of insurance is that if the losses happen sooner, before you kind of collected the little pot, then of course it will have a huge impact, like immediate impact on the cash flow. And you're trying to flatten the impact on the cash flow, but at the price. Like there's no insurance product that we saw, apart from, I think it was motor insurance, like car insurance, and a little bit of health insurance. Because these are very mature products and because there's a lot of data, they are kind of more fairly priced. all liability lines, D&Os, cyber, property damage, business interruption, even cargo. The one where there's a lot of competition, a lot of data points, and I believe we've built kind of the beta of the models that we had for all the different insurance lines. What we basically discovered is that it's bad. It's a better product. You're overpaying for transferring. You're paying through the roof for having that comfort that there will be no immediate hit to your cash flow, and you're just kind of trying to flatten the volatility, which is a very, that's a very it's a very complex decision. Like there's no black and white. For example, our shareholder believed that we should retain as much risk as possible because it made no sense for paying for the transfer. And we made the corporate decision that we would only transfer the tail, the catastrophic, super rare losses, which meant that over time, we raised our deductibles across the line on most of the insurance lines, because we wanted to retain as much risk. And we made the decision based on investigating our current controls and testing the controls and being comfortable that we are retaining this risk kind of knowingly and only insuring the tail. So the kind of this long-winded tail leads to a very important point. Insurance underwriters, they're not your friends. They make a lot of money on your ignorance of the actual risk profile. And by taking the time and effort to understand your own risk profile, you actually get rewarded by not overspending. And especially for local governments, every extra dollar, unnecessary dollar spent on insurance just deducts from other budgeting needs. What was your experience in dealing with underwriters and just generally kind of dealing with the insurance conversation within the government?
Yeah, well, I'd like to pick up something you said early on there, which is mental models, right? So I'm a big fan of mental models and knowing what your mental model is and changing it as appropriate. And you mentioned kind of in our opening remarks this idea that you've observed the kind of local governments becoming kind of more risk savvy. And the kind of conversation we've been having in our space is that local governments often maintain, or almost always maintain, a rainy day fund, and kind of thinking of rainy day fund explicitly as a self-insurance tool, because that's what it is, right? It's a self-insurance tool that's typically been around for recession comes along and reduces your revenue, or a catastrophic natural disaster happens and you need to respond quickly and decisively to that. And so where I'm going with this is that cyber is, I think, local government's going to have to change their mental model to be like, well, cyber, if the insurance is becoming unobtainable, unaffordable, and to your point, like on average is never a good deal, or insurance companies would go broke, like just by definition, right? They thinking about like, well, that cyber becomes one more thing that we need to self-insure against using our rainy day funds or other tools. And the question is then, how do we go about doing that? And taking a more quantified approach, as you suggest, would be the way to go about doing that. So this kind of change in mental model, I think
you've just raised like a super important point, because we've had that conversation, and I wasn't exaggerating when I said the shareholder, he hated insurance because he did the math, and he's like a PhD in mathematics. He did the math and he basically saw that it's 2, 3, 5, sometimes 6 times overpaying for your expected losses. So it's not even close to be fairly priced. And most of the time, the market kind of expects you to have certain types of insurances. So it's just the cost of doing business. Like you don't really have a choice. But sometimes he said, well, it makes no sense for me to insure this because we better self-insure or retain that risk. And for us, it was a very fascinating conversation with the CFO saying, you don't have to transfer the tail, but then you do have to adjust your reserves. You have to start building up the reserves, because you can't just say, oh, the risk doesn't exist, we're not going to insure it, so the risk disappeared. Well, that's not the case. The risk exposure it was before we insured, it was after we've made the decision to insure or not to insure. The risk exposure kind of is ever present. And how you deal with that, either you allocate money and reserve for it and you save this rainy day fund, or you transfer it to insurance, or you find what's the English name for that, when the companies get together into a pool and they kind of self-insure but within the pool because the limits are too big. So that there's that, and all of this becomes suddenly possible when you start moving towards quantification, because the step number one, and I think this is kind of a very long way for us to kind of to get to that point, but the point number one is understanding your actual risk profile and how that risk profile compares to the industry risk profile for any type of insurance, specifically for cyber, gives you a lot more ammunition to then decide, well, maybe insurance was never the right choice for that specific risk, or at least until the insurance companies figure out their game. Because at the moment, I mean, I just see and I saw quotes for the same risk profile just going almost random. Sometimes it would be closer to our fair estimate, sometimes it would be 10 times our fair estimate, and we would say, well, you all saw the same data. Your modeling could not be that different because we understand how your actuaries build models. We already looked behind the curtain, so there's no logic. And unfortunately, in liability lines like cyber, there's often very little logic in how they price the policies, and it's very important for you as the buyer to kind of to hold the cards and say, well, I know how much it's worth. Let's figure out if you can kind of go low enough to match our expectation. And if you have arguments by the way, I've met probably dozens of underwriters, global and reinsurance companies and insurance companies, all sorts of markets. I've never had an underwriter come to me and say, oh, we have more data, and hence we think your model and your estimates are not fair and you need to adjust them upwards. No one ever said that to me. So, and I would have accepted that, because if they truly, some of the underwriters truly do have more data, and if they can contribute and improve our internal modeling, then by all means. So I think that's the first point. Understanding your risk profile is absolutely fundamental and crucial to the success of the decision making, because and this is why framing in decision science is so important. Your question is not whether to insure or not to insure. Your question is to reduce the risk exposure and to protect against catastrophic events. Whether it actually ends up being insurance or something else is kind of irrelevant at the time of the decision point, because it's just one of dozens of options that's on the table.
Yeah, well, I think maybe two things you said I want to underline there for the group is number one, risk attitude, risk appetite. I think you mentioned your shareholder, right? You said, I forget the term used, but was not a fan of insurance, right? And that I would kind of, I guess, maybe imagine that you have a hyper rational shareholder, right? And you mentioned this whole idea of behavioral science, and some of your audience might be familiar with this concept of loss aversion, where people basically will value losses at twice the weight as an equal size gains. In other words, they'll be like, if you lose $100, that's twice as painful as winning $100. So if that's the case, right, like you can see why insurance is popular, because that big loss is like, people really don't like that. And maybe also to underline something you said that's very related is this reduction volatility is the name of the game, because people really don't like volatility either, and especially in local government, where you have services you have to provide on a day-to-day basis. And if, like, let's say, police or garbage, like that service, waste removal gets interrupted, that's a very bad thing. So how can risk managers essentially gain the benefit of savvy insurance purchasing, but also smooth out the volatility that's inherent in financing these risks internally?
Yeah, so, which brings us to a very important point, and this is kind of, I think it's unavoidable. The second step. So the first step is it's important to build your risk profile for the specific type of insurance that you're trying to place, because you may realize even at that stage that insurance is not really the right answer. But most of the time usually still is, despite what I personally think is unfair pricing. But then the second point is, once you have the loss exceedance curve, it's very important to understand, well, where is too much risk? And that's kind of your risk attitude, appetite, you can call it whatever. At some stage, you will have to have a conversation with the other decision makers in either the government agency or a corporation. You will have to have that conversation. And it was, I was kind of, I guess, lucky, because that conversation was had with me. I was presenting at the audit committee, and then the shareholder decided, first of all, he decided to join the audit committee. I don't know why. But then he decided to share with everyone what his risk appetite was. And he said, like, this many millions with that, probability is unacceptable for me. Everything else is fine. And that kind of, put the goalposts. Because your second decision is, how much risk do we transfer? Do we just transfer? And that's that has a direct implication on your deductible, or what is it? What do you call it in US? Retention?
Yeah, retention deductible.
Yeah, so that is also not a product of the market. It's a product of your organization's risk appetite. Because I've had this conversation, probably hundreds of times. The broker or the insurance company would say, well, these are deductibles that we can quote. And then I would say, well, thank you, but I don't care, because these are the other deductibles that we want you to quote. And because this is where our risk appetite is, and we need to test at different levels whether it's worth reducing or increasing the deductible. Because actually, as a general rule, and I'm skipping ahead a little bit because we haven't talked about the limit, which is kind of the most important thing. But on the deductibles, once you have the risk profile, a lot of the decisions become calculatable. You don't have to just accept somebody's word for it. And it's not like you don't have to follow this golden rule of, this is what we did last year, or this is what everybody else is doing. You don't have to follow the crowd, because you can make your own decisions. And so we would always get quotes for different levels of deductibles, because then we would plug in the new price and the new deductible into our model, into our loss exceedance curve, recalculate, and basically see whether the reduction in price of insurance is sufficient enough to cover the additional risk that we will absorb if we increase the deductible. And for example, we would increase our expected losses by 100,000, but then we would save 300,000 on insurance. So that would indicate to us that increasing the deductible to the next level is worth it, because we're saving on the cost of insurance more than the additional kind of expected losses that we're going to absorb during the year. So my takeaway from the risk profile, once you have the risk profile, this loss exceedance curve, it gives you so much ammunition for all sorts of decisions. And you need the loss exceedance curve, and you need the appetite of somebody in the organization to figure out, well, how much is too much risk.
Right. Well, exactly. And I would also maybe make 2 points to add to that. Is within the cyber market, I think many folks are being, we'll say, like strongly encouraged to take the approach that you're suggesting, by the fact that premiums are doubling in a year and that sort of thing. So like that gives some extra motivation to explore higher deductibles. But even outside of cyber, right, there's a lot of opportunity in that same vein. So even if you're watching this and you buy insurances that are maybe more stable, checking out some different deductible levels could still save quite a bit of money potentially if you have the ability to self-insure that amount. And the kind of wrapping it back to something we were talking about earlier in employee self-insurance, employee healthcare self-insurance, like stop loss coverage is a common thing in the cyber world, right? That maybe is something we're have to move towards, is like you're essentially insuring explicitly tail risk, that's what stop loss insurance is in healthcare, is you're insuring tail risk. In cyber, if it is going to be increasingly expensive, thinking about it, talking about mental models, like it's stop loss as opposed to just more regular, we'll call it more common types of risk that you're insuring against.
Yeah, which I think very nicely brings us to the next component of that decision is the limits and sublimits. Because what I observed in a lot of liability lines, there's just kind of this random industry practice that companies and organizations insure 50 million or 100 million or 200 million. That there's a menu that somebody somewhere came up with. And when I tried to investigate, and I did try to investigate, well, what's the logic behind the menu? Like, do you have actual data to support that, 50 is not enough and 200 is just right? Like where are those numbers coming from? And I found nothing. I found that basically these are just randomly generated numbers by somebody somewhere, and everybody kind of just plays along. On the other hand, what I have discovered is that understanding the limit or kind of determining or calculating the reasonable worst case scenario is probably one of the most important exercises that you can do in your risk analysis, because your loss exceedance curve essentially has kind of two components. It has the body and the tail, and the body is where you can obtain some industry statistics and your own company statistics, and you ask brokers and data providers and underwriters to share some of the data points with you, which by the way they're rarely happy to do, but we have to insist and encourage them to share, because at the end of the day, that's what creates transparency in the market, which of course underwriters probably don't want, but we as buyers want, and I think we have enough power to demand more transparency in the pricing of the different insurances. But then of course there is the tail, and usually there is not enough data for the tail. Plus, you just showed us very compelling kind of evidence that the tail increases every year. So you don't have a specific data point on the tail to say, well, this is the maximum, because you can see that there's a trend. The maximum is actually increasing from year to year. And what I've discovered, and this probably applies to cyber as well, we've done it for cargo, we've done it for property damage and business interruption. We actually had risk engineers, and I hope there will be more cyber risk engineers involved in this. We had risk engineers to walk around, investigate, do some control testing, and determine kind of plausible worst case scenarios that would then fit into our insurance conversation. Because, for example, losing a whole plant, we know the plant is big, but we know that the worst case is probably an explosion that will destroy, a certain percentage of the plant, and different ways of fire and the wind and everything kind of incorporated. So we had risk engineers help us a lot with determining what's the actual exposure. And what we discovered when we did that is that most of the time we were significantly underinsured. The worst case scenario were actually significantly larger than the historical limits that we had, just because somebody somewhere said that this was the industry best practice. On physical insurances, and we doubled and tripled our limits for some of the insurance lines. But then what we discovered on the other side, for the liability lines, we were actually significantly overinsured, because there was we found no evidence to suggest that this the industry best practice were actually supported by any kind of evidence. So we for some of the liability lines, we actually felt pretty safe reducing the limits. So the limit, to me, is also not a gospel that is just happens to be there, sitting in this vacuum. Sure. It is a calculatable, and there's a lot of value in calculating the limit for cyber. Is when you have an engineer to investigate, do penetration tests, do the actual control testing to determine, well, what are the different scenarios where you can have impact, and what are the kind of plausible impacts that you may consider.
Yeah, and maybe just to wrap some of that up into we'll call it a preliminary or intermediate takeaway for folks, is that we mentioned this distinction between, in passing earlier, between deductibles and retentions, where they're not exactly the same thing, right? They're often used interchangeably, but when you're retaining risk, that just means, well, what am I keeping for myself? and that includes a deductible, but it's not limited to deductible. It's also, to your point, Alex, it's what's beyond the limit. So if you have a low limit on your policy, you're essentially retaining everything beyond the limit. So kind of being cognizant of like, oh wait, we have like, for example, you mentioned this magical number that's out there. I've observed the magical number for local government ransomware tends to be $1 million. That's in the limit. And, if you look at that data, it could be more than $1 million. That could absolutely happen. And meaning the actual loss from an event could be more than 1 million. And so you are retaining that risk in addition to whatever the deductible is. So yeah, kind of being cognizant of both ends of this, the retention, if you will.
And I think the people critical. That you raise a very, very important point, because I think the people responsible for insurance, I don't think they're always transparent with the decision makers, saying, well, actually, what is the retained risk? Because it's basically everything below the deductible and everything above the limit. And unless you've done the homework and they build the loss exceedance curve, you don't really know what's kind of behind the limit, and that could be a lot. And when we actually did that, when we came back to the decision makers and said, we insured $500 million, but the actual exposure is like $3 billion, they said, well, wow, we are not comfortable retaining that risk, because this is not our strategy. And so yeah, fascinating how much information you can actually pull out from this simple exercise of building a loss exceedance curve for insurance purposes. And the two kind of important components is collecting data on the body of the distribution, and then collecting the scenarios on the tail of the distribution. I found very insightful and valuable working with the risk engineers to determine what are the different scenarios sitting on the tail, because that kind of, one of my principles is multi-use. It's like whenever we do something, we reuse it for multiple purposes. So the risk engineer went around, did the scenarios. Of course, we used it for insurance purposes, but we also used it to change the budgets and the investment programs for all the production departments for the following year, because we actually tried to mitigate some of the tail scenarios, but we don't have to just accept them and transfer them to insurance. We actually implemented a lot of controls and a lot of investment projects to reduce the probability of those rare catastrophic events.
Yeah, well, that's great. And the same thing applies to cyber as well, right? And it's like the whole, we kind of touched upon this with that loss exceedance curve that showed the values of additional controls, but the kind of I would not say real value, because deciding on savvy or purchase insuring is certainly a real value, but the ability to decide like, hey, I've only got so much money, like how much of this should I spend on risk transfer versus risk retention versus risk prevention by stopping this from happening in the first place, right? And we talked about changing mental models. Like, one of my most gratifying moments in doing this work is when local officials like, wait a minute, like instead of kind of having this big rainy day fund, shouldn't we spend some of this money on preventing, in this case, like natural catastrophes? Like people are kind of getting that, like prevent the forest fire or prevent the flood. And like, absolutely you should do that, because it's going to be a way cheaper in many cases to prevent the bad thing happening on the front end than to remediate it after the fact. So it does help.
You're touching on such important points, because once you have the loss exceedance curve, and then you can simulate the effect of different mitigations on the risk profile, you see that you can actually keep much lower reserves by spending a portion, a fraction of the amount that you had on reserve or on mitigation and prevention. And that just kind of makes this whole conversation so much easier. Speaking of gratifying moments, we had an environmental team that couldn't really build a business case for water purification plant for months and months. And there was like the decision just got delayed and delayed and delayed, and it was ridiculous. And we built them a risk profile showing like, what this is the exposure that you're sitting right now on, and this is the exposure that you continue to sit every day until you make the decision and fix the issue. And this is how much your risk will be reduced. Your exposure will be like a portion of what it was yesterday if you went ahead and made this investment decision, which they made much quicker for the team. So that loss exceedance curve kind of gives you so much ammunition to test and prove and highlight different hypotheses and really kind of make the important good decisions easier. And sometimes the decision could be not to insure, but to self-retain the risk, or sometimes it could be, in fact, go ahead and do the insurance, but maybe with the higher deductible because you want to specifically protect the tail.
Yeah, exactly. And maybe just to pick up on another point here, just to shifting topics slightly, something you mentioned in passing earlier, but is probably worth getting into a little bit more for your audience, is sublimits and other elements of policies to be aware of, because we're talking about kind of insurance policies in theory, right? And so far so good, but when you get into the practice, right, there's the fine print, and they say the devil's in the details, and that is true in insurance policies as well. So thinking about things like limits, exclusions, and understanding kind of what you might run into there is pretty critical. So like, what are the sublimits for different types of risks that you might be subject to, or are there exclusions that might change the cost benefit of this policy? Like, for example,
Absolutely.
very common exclusion is hardware damages from cyber attacks. Like, if your laptop gets bricked from a cyber attack, may not be covered. And kind of understanding what that is, because that's another form of retention, right? So if hardware is not covered, you are essentially retaining any risk that you might have to replace hardware because of a cyber attack. So really knowing is key. And it also helps, I think, to understand just some of the underlying logic behind this stuff, because it can, I think, just help folks be savvier purchasers of these types of insurance. Like, one of my favorite examples is I'm sure many of your audience members have seen in insurance policies in the fine print excludes acts of war, and maybe I've just kind of glossed over that. In the cyber world, like, wait a minute, with like kind of cyber attacks kind of that are launched or sponsored by state actors, like this now becomes like maybe a lot more tangible than it has been in the past. And like, well, why is that excluded? Is because the idea is that an act of war is a correlated risk. In other words, insurance companies will want to insure your dice set, right? Where they're rolling dice, they're independent, they'll insure that. They don't want to insure your domino set, where if like one domino goes, they all go. And the idea behind an act of war is that if there's an act of war, the cyber kind of damages will be widespread amongst many members of or many customers, I should say, and they would not want to have to pay out on all of them. And so kind of understanding that as a risk, you're retaining that as well. That if, like, especially for local governments, who could be, in theory, right, and this is not a far-fetched theory, could be the target of a state actor, right, who might want to sabotage the water system or whatever else.
Yeah, absolutely.
This is a risk that is retained because insurance policies, may not cover that.
Yeah, no, you raise very important points, because the fine print and the exclusions, that theoretically should adjust your data points on the actual losses, and that will change your risk profile. And I guess the good news is the markets are relatively immature right now, and most underwriters, I don't understand why, but most underwriters wouldn't be able to tell the difference between the risk profile with all the costs included and the risk profile with some of the costs excluded. And since most of the insurance policies are so overpriced, they will be so much above your expected losses, which basically the idea, the theory is that expected losses plus admin fee, kind of your expected return for the insurance company, that should be your fair price. Well, you'll never be even close to that. So the precision, what I've discovered, and because I started with building like very complex models with different specific underlying risks, modeling each separately, then kind of aggregating them into the overall loss exceedance curve, what I discovered that no one in the market cared about that. The market basically was willing to talk to us and give us discounts on even the most basic models, basically just Poisson times Pareto, with maybe like general Pareto on the table or on the tail, like with very basic basic models. So I think we are still pretty far away from the sophistication required for us to talk about all this kind of correct, but unnecessary right now points when modeling the actual loss exceedance curve. Right now, it's kind of just much more basic and immature on both sides of the playing field, and hopefully one day we'll get to where we will talk to actuaries directly and we will negotiate about the assumptions in the model. But right now we just we tell them like the fair price is 300,000 for this policy, and they would still quote 1 million. Like that's how that's how detached from reality some of the insurance pricing is right now. So there's a lot of space to play before I think the sophistication of modeling will come into play. I think that's the point I'm trying to make.
Yeah, well, and I think it also goes to the old saying, all models are wrong, some are useful, right? Like no model is going to be a perfect depiction of reality, but is it useful? And if it probably is, because if you're trying to just basically outperform your subjective judgment as to whether this policy is a good idea, a model would probably be quite helpful.
Yeah, and speaking of helpful, let's kind of just wrap up on that, because for us, we've proven the hypothesis that quantitating your risk profile is helpful, because last year we saved 13 million on different insurance policies across the world, in Europe, US, Latin America. We placed different risks, and that was across all sorts of lines. While actually we tripled some of the limits, we rarely increased the deductibles in the first renewal, and we improved the quality of coverage. So we spent a lot of time fixing the fine print and the wording and working on making sure that the coverage is better than it was last year. And 13 million for us, that was I think 40% of the annual budget of insurance. So huge reduction, huge. So in terms of worth it, no question for me. It was totally worth it. It paid for the whole risk management team salaries and bonuses for the next 10 years.
Nice.
So that was a nice business case for spending the effort in quantifying risk and immediately seeing the payoff. And we had one policy which we managed to reduce the tariff by 7 times, which kind of goes to say how bad the previous one was priced. But 7 times reduction. I mean, it was ridiculous. It saved 3 million in one go. So big carrot at the end of the quantification journey, I think, in insurance.
Right. Yeah, exactly. It's a $13 million carrot, in fact.
Yes, and that was just for us. We weren't even famous for this huge insurance portfolio. Our insurance portfolio was pretty minuscule compared to, and we still managed to save 40%.
Wow.
All right, Shayne, thank you so much. Any last thoughts?
No, I just thank you very much, Alex, for having me being a part of this session here, and thank you to everyone listening in for your time and attention here today.
Thanks, and we'll see you in the other workshops during the Risk Awareness Week.